see you. You're a good earner, but you feel fragile. You feel like you should be doing better than this. And that contradiction is exhausting, because on paper, everything looks correct. The income is there, the career is there, the effort is there, but underneath it, there's instability, a quiet tension that doesn't leave you, a feeling that at one bad month, one unexpected cost, one shift in the system could change everything. That's not failure, that's a structural gap. This tremor of anxiety every month isn't your fault. It's the distance between your earnings and the stability you were promised. You were told that if you earned well, saved consistently, and stayed disciplined, stability would follow. But the system changed. Costs moved faster than income, volatility increased, and the margin for error became smaller every year. That gap between what you earn and what actually protects you is where the anxiety lives. The traditional 1% rule of thumb is a trap. It's a relic of a different economic era. It was built for a time when rates were stable, costs were predictable, and the system moved slowly. Today, none of that is true. Yet people still rely on it, still anchor decisions to it, still wait for it to work again. It won't, because the environment it depended on no longer exists. As of March 2026, rates are averaging 6.10%. We have come down from the peak, but we have reached a plateau. This is the uncomfortable middle, not high enough to force panic, not low enough to create relief, just enough to keep people waiting. And waiting feels safe until you calculate the cost of time. Experts are divided. Fannie Mae predicts 6%, while the MBA sees 6.4%. This is decision fog, and decision fog is dangerous because when experts disagree, people delay. They wait for clarity, they wait for confirmation, they wait for certainty. But markets don't reward certainty, they reward timing. All eyes are on the March 11th CPI report. Only weaker inflation will push 30-year rates below 6%. But this is where most people misunderstand the system. You are not competing against inflation. You are competing against time, because every month you wait, your current rate continues to extract from you, quietly, consistently, and without pause. Waiting for the perfect moment is a cost. Research shows 50% of borrowers leave thousands on the table by waiting too long, not because they made bad decisions, because they delayed good ones. Waiting feels intelligent, it feels disciplined, it feels like control. But in volatile systems, waiting is often just hidden loss. The answer isn't a guess, it's a closed-form solution developed by Federal Reserve economists. This is where the conversation changes from opinion to mathematics, from prediction to structure, because the right decision isn't based on where rates might go, it's based on what your current position is already costing you. We call it the rate reset rule, and for daily use, we rely on the square root rule. It's not designed to impress you, it's designed to remove emotion, to give you a clear threshold, where action becomes mathematically correct. No guessing, no timing the market, no waiting for headlines, just a decision grounded in structure. It accounts for your state's fees, your tax rate, and how long you plan to keep the house. Because your situation is not generic, it is specific, local, personal, and any rule that ignores those variables will always fail you. Precision is what closes the gap between income and stability. Meet Sarah. She bought in 2023 at 7.7%. She's waiting for 5.5%, but her cash flow is bleeding right now. On paper, her strategy sounds disciplined. Wait for the right rate. Wait for the market to settle. Wait for the signal. But while she waits, the system is still running. Every month, her current rate continues to extract from her, quietly, consistently, and without negotiation. Waiting feels safe, but her cash flow tells a different story. In New York, fees average 2.1%. Sarah's $10,500 upfront cost makes her afraid to move, and that fear is rational, because upfront costs feel visible, immediate, painful. But what most people don't see is the cost of not moving. The slow, ongoing drain that doesn't appear as a single number, but accumulates over time. The system is designed to make upfront costs feel heavier than long-term loss. That's where most people get stuck. But the rule shows that acting now at 6.1% saves her $500 a month in interest. The math beats the wait. And this is the moment everything shifts. Because the decision is no longer emotional. It's no longer about hope or timing or prediction. It becomes structural, a simple comparison between what is happening now and what could happen next. And once you see that clearly, waiting stops feeling safe. To use the rule, you must know your CAPA, your total fees. There are 12 costs to watch for. Most people only see one or two, maybe the headline fee, maybe the closing cost, but the system is layered. Each cost is small on its own, reasonable, justified, but together they create friction. And friction is what prevents action. Understanding CAPA removes that friction. Appraisal fees can reach $2,000 depending on your property's size and complexity. And this is where the details matter, because every variable shifts the equation. Property, type, location, complexity. None of it is random. It's structured. And once you understand the structure, the cost stops being intimidating and starts becoming predictable. In states like New York and Massachusetts, an attorney is a mandated cost of the reset, which means this isn't just a financial decision, it's a regulatory one. Different systems, different rules, different friction points, and if you don't account for them, your calculation will always be incomplete. Precision isn't optional here. It's the only way the system makes sense. Geographic location is everything. Missouri is the lowest, DC is the highest. The same decision produces completely different outcomes depending on where you are. That's why generic advice fails, because it assumes a universal system. But the system isn't universal, it's local, and your decision has to reflect that. Refinancing isn't your only tool. A recast is the quiet secret of the mortgage world. Most people never hear about it because it doesn't generate attention. It doesn't create urgency. It doesn't fit into the standard narrative of refinance or wait. But it solves a different problem. And sometimes, it's the cleaner solution. A recast reamortizes your loan for a tiny fee, lowering your monthly bill without the $6,000 closing costs, which means you reduce pressure without resetting everything. No full refinance, no major transaction, just a structural adjustment. It's not dramatic, but it's efficient, and in systems like this, efficiency beats complexity. Scenario 3 is life-changing, rolling 22% credit card debt into a 6% mortgage, because now you're not just optimizing a rate, you're changing the structure of your debt. From high-cost compounding pressure to something slower, more manageable, more predictable. And that shift changes everything, not just your numbers, but your breathing room. You can save over $150,000 in interest just by shortening your term to 15 years. This is where the system becomes counterintuitive, because a higher monthly payment feels like pressure, but structurally, it reduces total extraction. You trade short-term intensity for long-term relief, and most people never run that comparison clearly enough to see it. If you took an ARM in 2020 at 2.75%, your reset is coming. Pivot to fix now to find stability, because what once felt like a smart decision becomes exposure over time. The system shifts underneath you, and what used to be predictable becomes volatile. This is not about reacting to fear. It's about moving before the structure turns against you. No closing cost doesn't mean free. It means the fees are hidden in a higher rate. And this is where language becomes misleading, because the system doesn't remove cost, it redistributes it from visible to invisible, from upfront to long-term. And invisible costs are always easier to accept, but more expensive to carry. Rolling $4,000 in fees into your loan can cost you $9,000 in total interest over the life of the loan, which is the core principle most people miss. Small decisions compound, not dramatically at first, but consistently over time. And consistency is what makes the system powerful, for or against you. Your plan starts with a fee audit. Call 3 lenders and get their CAPA number. Not to negotiate immediately, not to act immediately, but to see clearly. Because once you have multiple data points, the system becomes visible. And once it's visible, it becomes navigable. Once the math hits your threshold, act. A rate lock in 2026 usually buys you 30 to 60 days. And this is where discipline matters. Not emotional discipline, mathematical discipline. You define the threshold first, then you act when it appears. No hesitation. No second guessing, just execution. In New Zealand, the game just changed. 100% interest deductibility is back, which means the structure of the system has shifted again. And when the system shifts, opportunity appears, but only for those who understand the rules quickly enough. Because policy changes don't last forever, they create windows. One Auckland investor is saving $15,000 this year because they understood the rule change. Not because they worked harder, not because they earned more, but because they saw the structure and acted on it. That's the difference between reacting and positioning. New builds in New Zealand still have advantages. Lower deposits and exemption from DTI restrictions, which means not all assets are treated equally. The system prioritizes certain behaviors, certain structures, certain entry points. And if you understand that, you stop playing the game blindly. You start choosing your position deliberately. You don't need a hustle. You need a pivot. You need money made quiet, because more effort is not the solution. More clarity is. The goal is not to move faster. It's to move correctly, Once the structure is right, everything else becomes easier. The fragility gap closes when you move from anxiety to architecture, because anxiety is a signal. It tells you something is unstable, but it doesn't tell you how to fix it. Architecture does. It replaces guesswork with structure, and once you move into structure, the noise disappears. I'm Owen. This is Simple Money Habits. This is not about chasing trends or reacting to headlines. This is about understanding the system clearly enough to move without noise, to make decisions that hold, even when the environment shifts. Refinancing to extend your term can provide relief if you're facing temporary financial pressure, because sometimes the goal is not optimization, it's stability, reducing the monthly load, creating breathing room, giving yourself time to recover without breaking the structure. Scenario 6. If your equity hit 20%, you can refinance just to eliminate PMI, which means you're removing a cost that no longer serves a purpose, not adding complexity, not chasing a better rate, just removing friction. And sometimes that's the cleanest move available. VA loans have the friendliest reset structures with minimal documentation and no appraisals, because some systems are designed to reduce friction, not increase it. And when you operate within those systems, your decisions become easier to execute, not because they're simpler, but because the pathway is clearer. Don't forget the prepaids. You'll need to cover property taxes and insurance, regardless of the loan type. These are the quiet costs, the ones that don't change with your decision, but still need to be funded. And if you ignore them, your calculation is incomplete. And incomplete calculations lead to fragile outcomes. If your credit score improved since you bought, you can secure a better rate, even if the market hasn't moved, which means your position matters as much as the market. Your inputs have changed, your profile has changed, and the system will respond to that, whether you notice it or not. Refinancing is also the quiet way to remove a co-borrower due to life changes, because financial systems often solve life transitions, not just financial ones. And when your situation changes, your structure needs to reflect it cleanly, precisely, without friction. Cash-out refinancing for home improvements makes sense if you plan to stay for at least 5 to 7 years, because time is the hidden variable. The longer you stay, the more the structure works in your favor. The shorter you stay, the more it works against you. And most people don't calculate that clearly enough. Don't refinance just because your neighbor did. That's distracted consumerism, because the system is personal. Your numbers are not their numbers. Your timeline is not their timeline. And copying decisions without context is one of the fastest ways to create fragility. The Fed doesn't set mortgage rates directly, but their policy sets the tone for the entire market. This is where most people oversimplify. They look for a single lever, a single decision maker, but the system is layered. Signals move through it, and by the time you react to the headline, the shift has already happened. Historically, the 30-year mortgage rate is about 2 percentage points higher than the 10-year Treasury yield, which means you're not just watching mortgage rates, you're watching expectations, future inflation, future growth, future risk, and all of that is being priced in continuously. In 2026, tariffs and international conflict remain the wild cards that could push rates higher. These are the variables no model can fully predict. The external shocks, the unexpected pressures, the things that move the system suddenly, which is why waiting for perfect certainty will always fail. Precision is your only protection against volatility. Not speed, not emotion, not prediction. Precision, clear inputs, clear thresholds, clear action. That's what holds when everything else moves. If your break-even point is under 3 years and you're staying for 10, the move is clear, because now the decision is no longer subjective. It's not about how you feel. It's about alignment between time and structure. And when those align, the decision becomes obvious. We make money quiet so you can hear your life again, because noise is what creates pressure, constant decisions, constant signals, constant uncertainty. But when the system is clear, the noise disappears, and what remains is control. Sarah isn't looking at the rates anymore. She's looking at her children's savings account, because her decision is no longer driven by the market. It's driven by outcome, by what actually matters. And once you shift to that, everything becomes simpler. Join the Quiet Money Factory, where decisions are built on structure, not noise, not urgency, not opinion, just clear thinking applied consistently. Subscribe to Simple Money Habits, because the system is not getting simpler, but your approach can. The calculation begins at the link below, not with a guess, not with a headline, but with your numbers, exactly